Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. Once again, I want to welcome you to a subscriber request Tuesday video. These are videos I do where subscribers have asked me to cover certain stocks or even issues. In this video, I'm going to kind of kill a couple of birds with the same stone, if you will. I'm going to look at 7 or 8 stocks that subscribers have asked me to look at. But I'm also going to be talking about valuation, which is obviously my passion, and the idea that all stock price drops are not the same. And what happens is I will get, questions of, well, let's look at this stock now because the price was down 10%, or the price was down 20%, or the price was down 30%. And when people see that and they see those kind of headlines, I guess what automatically comes to mind is the stock must be a good buy now. Well, it's obviously a better buy than it was prior to dropping 20%. I'll give you that. But just because the stock dropped doesn't mean that it become a good value or it becomes a stock worth investing in. When I say all price drops are not the same, I'm simply pointing out there's a big distinction between a stock price drop from, let's say, insane or crazy valuations versus a price drop from fairly valued or even a price drop when a stock is undervalued. So let's go ahead and get into the video here and turn to the FastGraphs, the new FastGraphs tool that we just launched on Saturday night. And I've put together just a short portfolio. The companies I'm going to be covering today are Adobe, Comcast, Walt Disney, Jack in the Box, MasterCard, Smith & Wesson, Skyworks, and Visa. These were companies that I was asked to talk about, and all of them have their own little lesson or individual lesson in valuation, and that's why I really wanted to cover it. And another thing I want to add, there are certain stocks like Smith & Wesson will be one that I'll get into when I get to it that I really don't particularly want to cover because I don't think it's a stock that investors ought to be looking at. Okay, and that creates some problem when I get these requests. But I'm going to start with an easy one. I'm going to start with Jack in the Box, okay, and take a look at what's happened to the company and the valuation. Now, this is obviously a restaurant company, a hamburger chain, Jack in the Box, as we all know them, and they have some other franchises too. I'm not real familiar with this company, so I'm just going to do it from the perspective of FastGraphs. First thing I want you to see is that the stock is moderately cyclical. It has some, periods where earnings grow and then periods where earnings drop and then they grow again and drop again. And, during COVID, they actually did pretty well, interestingly enough, although they did reduce their dividend, which is the white line. They've only been paying a dividend, since 2014. But this is probably a really classic example of how crazy stock price action can be. Look at where the stock price of this company has gone. Now, in one aspect, and I want to make this very clear, in the long run, earnings drive stock price, and the price has clearly followed what the business has done. When earnings were good, the price was good, and the price went up. When earnings were bad, the price kind of languished as it did during this period. And then, of course, we had COVID, and we got this flash crash where the stock really collapsed here very quickly. I'm not going to hit the very bottom here, but it dropped over 65% from February 21st to April 3rd. That's obviously, quintessential definition of a flash crash. But then look at the recovery. Look how quickly it recovered back to fair value. Now, this goes to the point I made earlier. Not all price drops are the same. When the price was extremely high here, and although it didn't flash crash, it steadily dropped over the next several years. None of these drops became a value opportunity, even though they were rather large. Even if I go all the way to here, where the stock fell 34% over about a 3-year period here, it did not become necessarily a good buy. Of course, then the flash crash came. Anywhere it was below this orange line, it would have probably been an attractive buy. You don't have to buy it at the very bottom, so to speak, to make money. So I could have bought Jack in the Box here at $45 a share on April 10th, watched it fall, quite a bit further before all was said and done, and then have a really good rate of return, even after the recent drop that it did last week when the earnings announcement was a little bit weak. And I do want you to notice that. So I'd have still made a really excellent rate of return here. The point is, this is what buying value is about. This price drop was a price drop that was rational and then became attractive. Okay, and this price drop, it got overvalued again. This price drop brought it back to fair value. And then this little panic with the new, variant of COVID got people scared. And of course, company is showing weak earnings here, so it becomes very vulnerable. But the point is, this now probably is an attractive buy if you're willing to invest in a company like Jack in the Box that's a cyclical It's, expected to grow, at negative growth this year, as I mentioned, which is part of the weakness of the stock. But then the following year, it's expected to grow by almost 11% and then almost 13%. And so you've got an opportunity here, if this stock reverts back to a 15 PE, to make 19 or 20% a year over the next 2 years. Now let's visit that. The orange line on this graph is a PE of 15. There's certainly good evidence here to suggest that a 15 PE ratio could easily occur again. In other words, the stock could go back up and it would be a $100 stock to a $111 stock to a $126 stock over the next couple of years. And you can buy all you want today at 80.5. Okay, so that's Jack in the Box. That's one. Now, the next one I want to talk about is Smith & Wesson. I've been asked about this. Now, what's interesting about this, we also had this big drop in price, but look at the cyclical nature of this. Now, obviously, we know this is a gun manufacturer. That's, primary business. We had, after COVID and all the lockdowns and the politics going on, we had this huge surge in earnings, which was incredible. And now earnings are beginning to weaken and drop again. But the point is, earnings are expected to be pretty weak over the next several years. And if I look at it just from, normal price earnings ratios and even the idea that they may cut their dividend, I don't know if that's real or not. That's just a forecast. They've only been paying a dividend for a short period of time, or they did pay one for a short period of time. This is not necessarily an attractive opportunity here because of the sketchy nature of the business itself. We don't really know what this business might look like over the next 3 to 5 years. Now, there is expectations for high growth, so this would be what I would consider to be a very high speculation. But I do want to point out that if you're looking at it over the short time frame here, which is one of the real advantages of fast graphs, that we saw this price drop, but we're also seeing an expectation of over 30% earnings drop, which could obviously create a lot of negative sentiment. Not all price drops are the same. Here we have earnings and the price dropping in tandem. Okay, then we have things like Visa and MasterCard, which are great businesses, both of them. I really admire. I've actually made a lot of money in both of these stocks, although I did sell them when they got overvalued. But you can see the pressure that high valuation causes on these stocks. Both Visa and MasterCard have fallen quite a bit in very recent times here in the last, let's say, 6 months since the middle of the summer. We're going to actually August. We've seen a nice drop in price. We saw the big correction during COVID, which would have been a good time perhaps to have purchased these stocks. But the point is, neither one of them are necessarily really attractively valued. They're probably not too bad now. But, I would want to see MasterCard somewhere around $215 to $20 a share. And likewise with Visa, I would want to see it, significantly lower than it currently is. I'd like to be able to buy Visa at somewhere starting at around 112 and the stock trades at 202. So there is a rather substantial potential downside to this stock. Not all price drops are the same. We've had a very substantial price drop here as we did in COVID, but that doesn't necessarily make the stock attractive or, a low valuation at this point. Adobe was one I was asked about. It had a price drop, but it is so inflated in valuation that it doesn't even smell value, in my opinion. This stock is still massively overvalued, even though we had a 10 or 15% correction here. I think it was Friday or something. I don't really follow this stock because of its high valuation. The reality of it is these price drops don't mean a thing to this company when they're trading at nosebleed levels like this. Great business. Take price out of the equation and just look at the business and look at how steady the business has been growing in recent years here. And there's a lot to say about what you could like about this company. But the problem is the market is valuing it at just an insane valuation, in my opinion. It's way overvalued relative to what it should be now. The market's been applying a 41 or 2 multiple. The stock currently trades at almost a 50 multiple. That's pretty rich. It's an earnings yield of 2%. Come on, guys. Forecast growth is 18%, which is awesome, but it doesn't justify these valuations. Longer term, they're expecting 19 to 20% growth. Great story, great stock, but not all price drops are the same. This price drop hasn't even piqued my interest in Adobe, but again, a great company. Skyworks Solutions now is an interesting one because here we have the situation. We've got a nice text doc. I've covered this before in videos. You can see the relationship between earnings and market price so clearly here that the price tracks earnings. It gets disconnected, it comes back, gets undervalued, it comes back, gets overvalued, it falls back into alignment. This company's price drop now has created an opportunity to start considering the stock. You might not like the margin of safety here, but it does offer a minimal one. And you've got a chance to make a double-digit rate of return with a 7% earnings yield on a stock that's expected to grow at 8 or 9% over the next several years and over 20% a year long term. So this is, now you've got an opportunity to start nibbling or even to build a strong position if you'd like. Of course, I'd like to see a little better margin of safety, but I think here's a case where the price drop has brought us into a fair valuation territory. Comcast is a similar situation. If you look at this company, now you can see the effects of high valuation when this was a hot stock. The price of the stock did nothing. It was actually a negative rate of return for years, even though the company began to really earn a bunch of money here. It eventually went through the recession of 08 and 09. It got to an attractive valuation. You can see the price has tracked up, and here's a case of years of overvaluation. The price brought it into fair value. That would have been attractive. It stayed that way. It got a flash crash opportunity in COVID. From that, it went overvalued again. Now it's moving back into fair value territory and is actually buyable today again, just like Skyworks, with a modest margin of safety, but only a margin. Long-term growth is about 15%. This stock is beginning to look attractive, and that's where a price drop would lead to me wanting to say, hey, this might be a stock you might want to go ahead and look at today. The last one I want to cover is Disney. This is really an enigma to me, and I do want to make a point about Disney. Great business, okay? Disney, like Carnival Cruise Lines and a lot of other companies, AMC Theaters, these are stocks that COVID really hit hard from a standpoint of their business. Forget the price now for a minute and just look at what happened to the company's earnings and look what happened to the dividend. Completely eliminated the dividend. Earnings fell 19% in 19. Now they have a September fiscal year, fell 65% in 20. Their theme parks were closed, their cruise lines couldn't run. Now the stock is expected to have very strong growth going forward, but when you look at the pricing of this stock, it got absolutely insane. And now from its peak here, shorten the time frame so it's easier to do, from its peak price here, the stock now has fallen about 26%, over this course of this last period of time here, but it's still not even close to being at fair value. Now, the business is expected to start growing again. Long-term growth is going to be very high, but that's because it's coming off of a low base. I want to make that point. But Disney is really inexplicable to me. It's such an overpriced stock. It's very vulnerable to any type of bad news. We saw that with COVID when it got hit pretty hard, but yet it's a great business. When things are okay, if it wasn't for COVID, I think this company would have had great earnings. It wouldn't have seen this drop, but COVID did happen. It's a 100-year event, but those kind of things do happen. But the moral of the story is not all price drops are the same. Okay. You want to look for stocks that when the price drops, it brings the value into fair value. And that's when you can start looking at the stock. But don't just say, hey, I'm going to buy this stock like Adobe just because the price fell 15 or 20%. That doesn't mean that it became a good buy. It just simply it could mean it was so overpriced that even that drop in price doesn't even phase the crazy valuation that the stock has. Anyway, this has been Chuck Carnival. This is another Subscriber Request Tuesday. I covered a lot of stocks here that subscribers have asked to, but my main message here was the lessons on valuation that I feel this video has offered. It's always relative. Valuation is relative to price and the fundamentals of the business. You've got to mix the two and match them correctly to be able to make sound decisions. Just because a price drops doesn't mean it's become a good buy. And by the way, just because a price rises doesn't mean it's become overvalued either. I've shown you examples of that in this video. But anyway, as always, I appreciate you. If you like the video, give me a like, ring the bell so you can get, access to, reports on new videos that I'm doing. I'll be doing a lot of them. We're going to be doing a lot of tutorial videos on this new fast graphs. I'm so proud of it and so proud of our guys for getting it out. We've got a lot of enhancements coming. If you haven't looked at Fast Graphs, you might want to take a look at it. It's a great tool to help you become a better investor. And by the way, if you have used Fast Graphs in the past and left us, you haven't used the new Fast Graphs. So anyway, it's Chuck Carville saying thanks for watching. Talking to you guys again real soon.